markets now with Sylvia Jablonski, CEO and Chief Investment Officer of Defiance ETFs, and Lisa Erickson, head of the Public Markets Group at U.S. Bank Wealth Management. I don't know if anyone is really that enamored of stocks right now, Sylvia, because we very likely, when we do stop worrying about inflation, that'll just be replaced with worrying about a recession and an earnings recession. So we go just out of the frying pan into the fire. I don't know. It's some people think inflation is much worse, but neither one is a great environment for stocks.
Yeah, I mean, it's true. It's hard to get excited right now about any kind of risk exposure and getting into stocks, just given what the last week looked like. You know, we started off with good news around CPI. We actually see that inflation is falling, and the logic there is that, you know, when inflation peaks, usually 12 months out from there, you see S&P 500 returns 13% up since the 1950s. So it seems like a good case to sort of think about getting back into the market. But then, as you said in your opener today, the Fed was just mean, you know, higher for longer. 5.1% terminal rate doesn't go higher than that. I think it really confused markets. And now there's this tug of war between the Fed and markets. But, you know, I do think there is some good news here. Inflation is giving. And yes, we know that growth will probably slow. It will indefinitely slow. But if we think about what that means, you know, a year out from the peak of inflation is essentially next June in 2023. And markets tend to recover about 5 months before recessions end. So if we think we're going to get that soft landing and next year is really going to be, you know, the brunt of the worst of the news for the first 6 months, you can start to look through this stuff and think about long-term investing and gathering up some deals here.
Do you go into some type of fixed income or something, Sylvia? I mean, you like the 2-year? It's not awful. It's not as high as it was, but I guess you could put money there for 2 years. Is that better than high-yielding stocks?
I think, in the short term, I think it's probably a safer bet. And I think, you know, if you take a page from the book of the hedge funds, they're sitting in cash and they're looking at these, you know, short-term cash instruments. And I just even hear, you know, anecdotally, retail investors around me talking about these great CD rates that they see out there for the next 6 months to 12 months. But again, if you have a vision beyond 2023, you want to be in stocks because stocks are going to be the place to be. There has been a big re-rating in the market. Valuations have fallen quite a lot. And I think once we get past this higher for longer setup, and we're looking into 24, 25, you know, looking back at these entry points here, this is where value creation happens. So I wouldn't give up on stocks. You know, I would sort of start to dig into some of the names that I like for the longer term now and buy them up at a deal.
Not sure what to make of this, Lisa. The Journal decided to write a piece today that individual investors have been doubling down on stocks. Professionals, however, have bailed out. Small investors stay bullish, even as the pros unload stocks. If you think that we eventually, you know, stocks are always the best investment long term, what does that say about pros that Meta down 70% or anything that you used to like that these pros liked a year and a half ago? Everything's 50. A lot of things are 50% down, 50%. Why are they not bullish now? Are individual investors bag holders?
When we look at what's going on in the markets, it really isn't that surprising that institutional investors are more cautious, and we ourselves have a more defensive stance. And it really is on the back of the fact that when you look back at 2022, we've had a first repricing based on higher interest rates and inflation bringing down the multiples that are afforded to equities. But we really haven't seen much evidence yet of a second repricing, meaning that as price pressures continue and as consumers potentially continue to slow down their spending, those earnings numbers themselves could come down, again, causing some further decrease in overall how stocks are priced. So there are really reasons for some pessimism. Obviously, we, like everybody else, continues to hope to see inflation come down at an even faster pace than it has been. But there are caution signs out there.
I mean, that is a little bit worrisome, though. So the earnings recession is coming that everyone talks about. Margins are going to be squeezed. So you've got consumers maybe getting tapped out a little, and then companies aren't going to be able to raise prices to keep margins where they were. So margins are going to get compressed. So sales can go down and margins go down, and that just will show up in the bottom line. So on a lower multiple, stocks could go even lower with lower earnings.
Yeah, to your point, Joe, really, we're cautiously watching what's going on with the data. And while we're seeing some tiny signs of green shoots in the macro data, they're very minor. And really, what we're seeing overall, whether it's here in the U.S. or globally in developed markets overseas like Europe, UK, other developed countries, is really that deceleration in the growth continues to come. And so what we want to do is to continue to monitor the data. At some point, it will turn, to Sylvia's point. But again, we think a defensive stance right now really makes more sense, where less of an emphasis in the near term on U.S. equities, as well as, to your point earlier, Joe, emphasizing some of that higher quality fixed income makes more sense.